Up to now we've examined combinations of moving averages. We've already seen that an MA with a shorter period is faster than an average of the same type with a longer period. We know that how the averages interrelate with each other is a trend indicator. If the faster line is above the slower line, it's an uptrend, and if it's lower, then it's a downtrend. But what should we do if the trend reverses or flattens into a trading range? To mark trend zones and to differentiate them from reversal points, we use an indicator which is based on the difference between two moving averages. It's called the price oscillator, where MAN1 is the faster moving average and MAN2 is the slower one. It stands to reason that N1 is less than N2, and this is what the indicator looks like. The price oscillator has a value of 0 at the points where the two moving averages cross. If the fast line is higher than the slow line, the oscillator has a value above 0, and if the fast line is lower than the slow line, the oscillator value is less than 0. Let's identify the areas where this indicator is rising and is above 0 and falling and less than 0 and shade them. We can confidently claim that in these zones there is a trend and it's either rising or falling. And what's going on in the unshaded areas? We do not know. The trend has either reversed here or it's paused. In other words, all we definitely know is that the previous trend has gone, and it's not important how long for. The previous trend has gone, and that's all we need to know. Note please that I've said nothing about the type of moving averages to use. They should either be simple or exponential moving averages. The choice is yours, and that's why we've written them just as MA. I'd now like to discuss the selection of the appropriate time periods N1 and N2. Let me run through a few examples. Here is a daily chart of Japanese yen. The values of N1 and N2 have already been selected. They are 7 for the fast line and 65 for the slow line. But why? 65 is 65 trading days, that's 3 months, a quarter, it's a natural cycle. 7 is approximately 10% of 65, and it has been selected experimentally. The profit to be made using this simple price oscillator has been calculated on the basis of closing prices displayed in the green areas. At first sight it looks pretty tasty. But look at the red areas. There will be no earning opportunity and you could even suffer losses. To deal with this problem, traders employ a number of indicators, RAVI, MACD and RSI simultaneously. We'll move on to speak about them soon. Take a look at the hourly chart for the euro that's now in front of you. Now the time periods for the price oscillator are 12 and 72. 72 hours is 3 days. 12 is 12 hours or half a day. Although these figures have been selected experimentally, the slow moving average is a natural cycle. Once again, the shaded parts of the chart are areas where in the worst possible scenario we will fail to make a profit, but in the best possible scenario we will make money. The value of the yield corresponds to the number of time periods. The fewer the time periods, the smaller the value of the possible profit. Never forget that.